Happy Friday, everyone. Jason Jacoby here with the closing bell. Hope you're all doing well and enjoying your summers. Data keeps coming out and showing that people are traveling at record rates right now. People are continuing to spend. Saving rates are about 4.5%. So economy's still looking pretty strong. Obviously, if you've been reading or listening to our stuff, there's been a tale of two economies. You've got contraction in some economic sectors. Services is still strong in expansionary territory, but moving forward, depending on the continued inflation data, which we'll talk about in a second, and then also talking about jobs market, labor market, still pretty strong. Numbers are continuing to exceed expectations in terms of numbers of people employed, which is again a good thing, which improves prospects for a soft landing or at least a really mild recession. Again, we'll digest data and bring you along this journey with us as the numbers develop. But let's dive in. I want to keep it short. There's some numbers I want to talk about. So the Fed's preferred inflation gauge, PCE numbers, stands for Personal Consumption Expenditure Report, came out this morning. Headline PCE came in at 3%, 80 basis points lower than the previous month's reading. Now again, there are month-to-month increases, and this last month increase in terms of inflation was about 0.3% for core and headline. Again, remember, core strips out the volatile food and energy prices, but those numbers came in basically along the lines of expectations. But the Fed looks at year over year because that's the big inflation picture. So we're seeing that trend in the right direction. Again, 80 basis points lower on the headline numbers, which include the volatile food and energy prices. Now, when you strip those out, it's called core PCE or core inflation. Now, with those volatile numbers stripped out, we are standing tall at 4.1%. Now, that is down from the previous months of 4.6%. So again, trending in the right direction. It's really good. We like those numbers to continue to come down. Now, the only cause for concern, and concern, I want to say this with a grain of salt here, because I'm not really concerned for the long-term aspect of the economy or trying to instill fear in my clients or our clients or potential investors. What's more concerning is the Fed just hiked rates again this week, 25 basis points, which again is in the newsletter if you want to read more about it. What's more concerning with that is we haven't really felt the last 6 months of rate hikes or pauses, or in cases moving forward where there are going to be rate cuts. We don't feel those for at least 6 to 9 months. Again, so we got this backlog of rate hikes from the past 6 to 9 months, and that's not fully baked in or integrated into the economy yet. So we want to watch those numbers. We're already trending in the right direction. I really wish the Fed would pause at this point to give us some time to catch up because the numbers are trending in the right direction. But the Fed seems hell-bent on continuing to raise rates and be data dependent. Obviously, we wish that the supply side would open up. What we need is more supply in the economy to ease inflation pressures as well, among other things. But for the benefit of this video and keeping it short, the numbers are trending in the right direction. So that's what we like to see. The markets seem to be responding well today, up almost 1% at time of recording. So stay tuned for more. We'll be back with you next week on the Friday's edition of the Closing Bell. Thanks so much for everything that you stand for, that you do for us. It's an honor to serve all of you. We'll see you next week.